If you own or if you are considering owning Supermicrocomputer, ticker SMCI, the Nasdaq AI stock, this next few minutes could save you a fortune or it could unlock massive gains. For the last few months, this stock has been a battlefield. It shot up to dizzying heights near $62, riding the hype of the AI boom, only to have its knees blown out by a catastrophic Q2 earnings report. A 30% crash, wiping billions off the market cap and sending investors fleeing toward the critical $42 support level. But then, the bounce. On October 1st, we saw a sudden, furious 9% surge, pushing SMCI back to $52. This wasn't just a bump. This was the market making a decisive, violent move. Why do we care so much about this volatile stock? Because SMCI is the secret weapon of the AI revolution. They are the custom server manufacturer building the exact boxes that house all those expensive NVIDIA and AMD GPUs. Without SMCI, the hyperscalers, the Metas, the Amazons, can't run their AI models. Here is the double-edged sword. This company has 47% revenue growth, explosive, but it's crippled by paper-thin margins, sitting at just 11.2%. Downward guidance and tariff fears are still hanging over this stock like a dark cloud. So this is the ultimate question we are answering today, and it's critical for your portfolio. Is SMCI at $52 the forgotten AI winner poised for another moonshot? Or is this rebound simply a trap, a final moment of euphoria before a deeper, painful correction? We are spending the next hour breaking down the financials, the catalysts, and the precise moment to buy, hold, or sell. Let's get started. Let's start by contextualizing the wild ride. When a stock plummets 30% after an earnings report, even if revenue is up, investors hit the panic button. Why did it fall so hard? The market was spooked by a combination of a slight revenue miss, $5.76 billion versus $5.88 billion expected, and critically, margin compression. Now for the good news. The fundamentals are actually explosive. For the full year 2025, SMCI hit $21.97 billion in revenue. Think about that. That's a 47% year-over-year growth rate. That is not a struggling company, that is a growth monster. But growth needs to translate into profit. And this is where we need to put our analyst hats on. The main problem is margins under pressure. Their gross margin in Q4 of FY25 dropped down to roughly 11.2%. Compare that to the prior year when it was sitting comfortably at 17%. That is a massive squeeze. It's due to high supply costs, they're rushing to get chips, and a less favorable mix of products. Their net margin is just 4.77%. But there's a silver lining. Let's talk balance sheet strength. This is where SMCI shines and why it avoids the house of cards narrative. Their current ratio sits at an impressive 5.25x. That is fantastic liquidity. It means they have 5 times the assets to cover their short-term liabilities. They can easily weather supply chain volatility or short-term cash crunches. Their debt-to-equity ratio is reasonable at 0.80x. No excessive leverage here. And their return on equity is strong at nearly 17.9%. So the plumbing of the company is solid. Now, the one caution here is free cash flow or FCF. At 35.58 million TTM trailing 12 months, it's positive, but it's thin relative to their massive market cap. They are pouring every dollar back into growth. We need to see that FCF thicken up as they hit scale. It's worth noting who their customers are. Hyperscalers like Meta and Amazon are huge, and when those big fish buy, they buy big. High-density AI racks. SMCI edges out competitors like Dell and HPE on customization speed, but they still lag behind those behemoths in pure scale and enterprise reach. Alright, let's pivot to the future. If you own SMCI, you own it for these three mega growth opportunities. 1. Blackwell GPU ramps. This is everything. NVIDIA's next generation Blackwell GPUs are expected to generate monumental demand. Analysts project that this alone could push SMCI's FY26 revenue to a staggering 33 billion plus. That's another 50% jump from the already explosive FY25 numbers. That's a powerful engine. 2. Liquid cooling leadership. This is SMCI's secret weapon, direct liquid cooling or DLC technology. As AI chips get hotter, old air-cooled data centers are becoming obsolete. DLC is essential for efficiency. This technology is expected to be used in 30% of all new data centers. Why does this matter for the stock? DLC systems have a higher average selling price and carry better margins. If SMCI can dominate this niche, it solves their biggest problem, those compressed gross margins. 3. Global expansion. To offset trade war risks, SMCI is strategically opening new facilities in Europe and Asia. This diversification is critical to counter potential new US tariffs, like the talk of Trump policies, allowing them to serve their global hyperscaler clients more reliably. Also, they are actively diversifying their supply chain beyond just Nvidia and AMD. They know relying on two chip giants is risky. This proactive move is smart, long-term risk mitigation. Now we transition from what they do to where the stock stands. Let's look at the market psychology. We use the boom, euphoria, profit-taking model. Where is SMCI today? It fits firmly in late boom, early profit-taking. The hype peaked at $62, euphoria, but the Q2 miss triggered rotation. This recent rebound places us in the early profit-taking phase, with a model score of about 70 to 80. The market is taking its breath. Let's look at the numbers that define this phase. The trailing PE is about 31x. That's high. It bakes in a ton of AI growth already. The stock has run up 72% year to date, but that performance has lagged rivals recently. A classic sign of profit-taking fatigue. Now, let's get into the most compelling numbers on the balance sheet table that might argue for a hidden value. First, forward PE is 20 times. This assumes the 50% growth rate holds for FY26. If they hit that $33 billion target, 20 times for a 50% grower is actually quite reasonable. But that's a massive if. Second, the metric I love. PEG ratio. It sits at a beautiful 0.67x. Remember, anything under 1.0 is considered undervalued relative to its growth rate. This is the single strongest argument supporting buying on the dip. Third, EV/EBITDA is 20.3x. This is a premium to most server peers, which tells you the market believes the future gross margins will improve beyond 11%. It justifies the premium if margins rebound to 13% or more. The analysts are mixed, which is perfect for this stage. We have 15 buy ratings, but the average price target is only $47. If the stock is at $52 and the average target is $47, that suggests a slight downside risk in the short term, confirming the caution within the early profit-taking phase. The recent break above $50 resistance is bullish, but the $42 support needs to hold. If we see a breakdown below $42, we are shifting from early profit-taking to a deeper, more painful profit-taking acceleration that could test long-term structural support. Let's talk about the risks, because if you ignore these, you're just gambling. Risk 1. Chip dependency. We mentioned it earlier, but let's emphasize this. 80% plus of their business is tethered to the success and supply schedule of Nvidia and AMD. If there are Blackwell delays, SMCI's Q3 commitments are instantly hit. They are an enabler, not the creator of the chips, meaning they are always dependent on someone else's timeline. Risk 2. Competition is gaining ground. Dell and HPE aren't sitting still. They are aggressively pushing into the custom AI server market. Worse, The customer base is becoming a competitor. Alibaba is developing its own in-house AI chips. If hyperscalers choose to build their own systems, that cuts SMCI out of the loop entirely. Risk 3. Valuation vulnerability. I mentioned the forward PE of 20x. It's only valid if they hit $33 billion. If they miss by, say, $3 billion, that valuation instantly looks bloated and the stock is vulnerable to a sharp correction. Risk 4. External noise. We still have the lingering concerns over potential tariff impacts, and yes, there was an auditor resignation fallout. And let's not forget the high beta of 2.75. This means SMCI stock moves 2.75 times faster than the overall market. When the market goes up, great. When it drops hard. Okay, you've seen the good, the bad, and the volatile. Now for the strategy. What should your next move be at the $52 price point? If you are a buyer, don't chase the post-rebound rally. Wait for dips back into the $42 to $45 support zone. That offers the best risk-reward entry, potentially setting you up for that massive 82% upside if the intrinsic value models that see $95 play out. If you already hold the stock. If you have conviction in the long-term AI story, hold tight. But be disciplined. Use a protective stop. I would recommend trimming your position if the price consistently falls and closes below the hard $40 support line. The best play? Accumulation. For most long-term investors, the safest way to manage this high beta is dollar cost averaging, DCA. Accumulate gradually, perhaps buying on every 5 to 10% correction. This strategy capitalizes on their massive FY26 catalysts while minimizing the risk of chasing a volatile top. When to sell or trim? If the stock approaches $60 resistance, which was the old support, and you see any further weakening of Q1 guidance, that's a great spot to take some profit off the table. Crucially, always set a trailing stop 15% below the recent peaks to lock in those gains. Portfolio fit. This is a high reward, high risk play. It should only be a 5 to 10% allocation for growth or aggressive investors. Pair it with stops to protect your downside. The next few months are critical. Put these dates on your calendar. November 4th, 2025 is the Q1 FY26 earnings report. We need to see revenue in the $6 to $7 billion range and EPS guidance of 40 cents to 52 cents. We also need concrete clarity on those tariffs. Beyond earnings, watch the product launches. Blackwell Ultra Volume ships in Q4, and the rollout of green DLC servers will be a huge indicator of their margin potential. Also, keep an eye on institutional inflows post-stock split. Are the big funds buying the dip? Final conclusion. Let's bring it all back home. SMCI is a powerful company with undeniable 47% revenue growth and strong AI tailwinds. But the constant guidance cuts, the intense competition from Dell and HPE, and the chronic margin pressure cap the next NVIDIA narrative. It's better to view this as high conviction growth with high volatility. So, SMCI at $52, it is a potential rebound gem if the catalysts hit. But it's a cautionary pullback if the AI hype begins to cool rapidly. The stock's future depends entirely on its ability to execute on Blackwell and improve those margins. That's all for today. If you found this useful, please hit the like button and subscribe for more deep dives. Let me know in the comments, are you buying, holding, or selling SMCI right now? Thanks for watching.